Welcome to Yahoo Finance's Morning Brief, presented by Robinhood, the home to commission-free trading. I'm Julie Hyman. Let's get to the three things you need to know today. First up, we've got some breaking news. Netflix and Warner Brothers Discovery have reached a deal. Now, Netflix will buy Warner Brothers after the studio and streamer splits from the cable assets that are under the Discovery banner. It's a $72 billion cash and stock deal, and the agreement brings together a streaming giant with one of Hollywood's most storied studios. It also brings an end to a heated bidding war between Comcast, Paramount Skydance, and the streaming giant, Netflix that is. The acquisition marks a strategic shift for Netflix, which has never made a deal of this scope. Plus, investors are awaiting key inflation data that's been on hold due to the government shutdown. Personal consumption expenditure data, PCE, for September is due out at 10 a.m. Eastern. It's the Fed's preferred inflation gauge, and it'll bring more insight into its battle to tame rising prices. Wall Street's betting the Fed will still lower rates next week, which has helped bring stocks back to the brink of a record. And Apple is seeing a wave of executive departures. The company's general counsel, the latest to leave the iPhone maker. That latest reshuffle follows the departure just this week of Apple's AI head and its longtime design executive, Alan Dye. The exits follow COO Jeff Williams, who retired last month and was long seen as a number two to Tim Cook. All of this brings into question Cook's succession plans, but also bigger questions about Apple's AI ambitions. While the stock is up over 13% this year amid strong iPhone sales, the company's artificial intelligence rollout has not been as successful. Let's get a check-in on stock futures. We are on record watch for the S&P 500, but we're not going in the right direction for that today, or at least not right now. We're very little change to the downside for the S&P 500. The Dow also a little bit change to the downside. The Nasdaq a little bit change to the upside. So we have not seen big moves really in recent days. Let's dig into our top stories of the day now. Netflix announcing a deal to buy Warner Brothers movie and streaming business for $72 billion. Delayed PCE data due out ahead of the Federal Reserve's rate decision next week. Plus Apple announcing the departures of more senior executives. Joining me now, senior reporter Ali Canal live at the Nasdaq, Federal Reserve correspondent Jennifer Schonberger, and tech editor Dan Howley. Now, Ali, this isn't quite over yet. We've been talking about this saga, this battle for Warner Brothers Discovery, a huge development this morning with Netflix agreeing to buy the movie studio as part of the business.
Yeah, and a surprise to many on Wall Street as well. One analyst from Citi had given a 60% chance that Paramount was going to win out here, but Netflix just really came out of the woodwork here and surprised with this acquisition. Now, Netflix is going to acquire the studio and streaming assets. So that includes the film and TV studios business, HBO, HBO Max. It's a deal that's valued at $72 billion plus debt. And it's one of the biggest entertainment takeovers that we've seen in recent history. And for Netflix, it's particularly important because they've historically been more of a builder than a buyer, although they did say on their third quarter earnings call that some strategic M&A could make sense for them. However, they've largely been neutral when it comes to mega deals. So I think this was a surprise to many on Wall Street. Now, here's what Netflix gained. They gain the scale and control. They're getting some of the most iconic franchises out there. That includes Harry Potter, Game of Thrones, The Sopranos, Friends, DC, and they're keeping these assets out of the hands of competitors like Paramount and Comcast, and those two were also in the running for this acquisition. But clearly investors, they're a bit jittery, they're a bit nervous this morning. You're seeing shares of Netflix off nearly 4% in early trading. And the reason why is a few different things. One, this deal is expensive. It's complicated. Netflix has never made a deal of this size. They're now getting involved with a legacy media competitor here. What does that mean in terms of labor costs, production costs, and also the regulatory overhang, which we know is going to continue to be an issue that Netflix will face in the near term?
Well, and there's already been some chatter about that latter part in D.C., and it was widely seen that Paramount Skydance, whose leaders are close to this administration, I think it's fair to say, that regulatorily they would have an easier time.
Yeah, David Ellison, the CEO of Paramount Skydance, he was already able to get this deal done between those two companies. And across Wall Street, Paramount clearly had the edge when it came to that regulatory approval, also due to its size. Now, in the interim, as we go through this regulatory process, Paramount and Comcast could continue to engage with WBD. And we know that Paramount sent a letter to the company accusing it of unfair practices. WBD responded saying that they are an independent board. They're doing everything in their fiduciary powers to keep this process fair. But I don't expect this fight to be over. Paramount really needed WBD. They are behind in the streaming wars, and this is a major loss for Paramount. So I think they're going to fight to the end to see if there's any sort of resolution here. And also, remember, Netflix is not going to acquire the studios and streaming side until the planned split happens, which is going to occur in summer 2026. That's at least the timeline for now. So this is still a very lengthy process, and there's going to be a few hoops that need to get jumped before we get to the finish line.
Oh, just when you thought you were done, we were done talking about this one. We are far from done talking about this one. Let's talk about another giant within tech that we've been watching closely that's been seeing some really interesting changes. Dan Howley, I'm talking, of course, about Apple that has seen quite a few management shifts as of late. As we take them all together and kind of zoom out, what does this mean for Apple? Is it a change strategically in direction? How are we to read this?
Yeah, I mean, look, where do you want to start? COO Jeff Williams, who was supposed to be the front runner to be CEO, he's retiring. Head of Government Affairs, Lisa Jackson, she's leaving. General Counsel Kate Adams, she's leaving. Alan Dye, one of the heads of design, he's going to Meta, getting poached. And then their AI chief is also retiring. I think there's a number of factors here. Some of the people who are leaving were close to retirement age. Jeff Williams, close to retirement age. That's why the idea of him being a follow to Tim Cook became more difficult over time, just because he was around Tim Cook's age. As far as the AI chief, that's kind of because they're not doing so hot on AI. I mean, Siri's been delayed for quite some time. That was supposed to be, their big come out. They were running ads on TV, for God's sake, saying that this is going to be out. And guess what? It's not. And so there's been a lot of turmoil there, a lot of tumult. We've seen, reports that they may lean on a different model from Google, things of that nature. And then, of course, we were speaking more recently about who would succeed Tim Cook himself. And so, I think that this is a broader transitional period for Apple. I don't think there's any fundamental issue going on at the company outside of AI. There's obviously still challenges. What's the next product after the iPhone? That's been the $1 trillion question, I guess, since the iPhone maybe 10 came out. You got a cool new design. What's next? And it's not the iPhone Air, apparently, because that's not selling so hot. And so I think there are fundamental problems at Apple that any large company would have, but I don't think this signals any kind of the wheels are falling off this car.
Well, I should say, Dan, shareholders certainly don't believe the wheels are falling off the car. I mean, the stock closed at a record 3 days ago. It's not up huge this year, but it's up about 12% this year. So that doesn't behave like there's no hope for the company, certainly.
Yeah, absolutely not. And I think a lot of that has to do with what's going on with the most recent iPhone sales. And I said the Air not, performing well, but the Pro is, the standard 17 is. So, and that's really the bellwether for Apple. Is the iPhone performing well? Do services continue to improve as far as revenue goes? And, everybody's going to be happy if that's the case for some time. And then, once AI gets sorted out at Apple, I think, people will be more excited. Again, I still stand by the fact that nobody's rushing out to buy a phone because of its AI capabilities. It's just not the case. People are going to go and use ChatGPT on the web or their app, or they'll use Gemini on the web or the app. I don't think anyone's saying, I think most people just say, well, Siri, is awful. And that's, That's kind of been a given for, I don't know, 10 years now. So it's not as though that's new. They just still buy the phone. So if it was a problem, they wouldn't have been doing that. They've been going to Google, which has had better AI for a while, but that's not the case. So I do think that, there's problems at Apple as far as AI. This, I think, is just a confluence of events where it's, the AI lead is stepping down. We're getting a new one, and then we just had some, retirements and some poaching and some defecting, and so it's. I think that's basically the kind of big takeaway from it. It's not the end or death knell for Apple,
right,
obviously, but it's. I don't think it's a larger structural issue with the company.
Yes, TBD. We'll see what happens after all of these management changes. And then finally, we got to talk about economic data coming out today. We're used to it coming out at 8:30, but it's coming out at 10, Jen. And we're talking about PCE, personal consumption expenditures.
Yes, the Federal Reserve is going to get one last reading on inflation before their policy meeting next week, and that is on the personal consumption expenditures index on a core basis, which strips out those volatile food and energy prices, which is how the Fed prefers to look at inflation. We expect a 0.2% increase month over month, which would hold the same level from August. This is for the month of September. So this data a bit stale, as of course we had that government shutdown and data has been delayed. Now, year over year, we expect an uptick of 2.8% for September. That will be down a tenth of a percentage point from 2.9% in August. So again, this data is stale. It's not expected to change the calculus for next week. If you are in the camp of worrying about inflation, you are still probably in that camp. If you are in the camp about worrying about the job side of the dual mandate, then you're still probably going to be in that camp as well. And I'd also just like to point out that Fed officials had projected back in September that inflation would end the year at 3.1% on core PCE. So at 2.8, that's coming in under that estimate. I still think, as I said, this doesn't change the calculus, and we could see dissents on both sides. We know that Jeff Schmidt from the Kansas City Fed dissented last meeting. There's nothing that I think would preclude him from doing so again this meeting. And Susan Collins, who's a voting member in December of the Boston Fed, she has also showed some concern about cutting rates again. So it's possible she could dissent. And of course, on the flip side, we know that Fed Governor Stephen Miron prefers to go by 50 basis points, and I expect the Fed to go by 25, so he could dissent on the downside.
Jen, Allie, Dan, thank you so much. Appreciate it. Coming up on Morning Brief, we'll bring you today's top trending tickers and also dig more into this Netflix Warner Brothers deal. We'll be right back. Welcome back to Morning Brief, presented by Robinhood. Now time for some of today's trending tickers. We are watching Southwest, HPE, and Victoria's Secret. First up, Southwest Airlines lowering its profit guidance for the full year. The airline cited disruptions from the 43-day-long U.S. government shutdown, as well as higher fuel costs. Southwest is now expecting 2025 profit of about $500 million. That's down from previous estimates of $600 to $800 million. And this follows similar commentary from Delta Airlines CEO Ed Bastian earlier this week. He said that flight cuts during the shutdown would lower Delta's pre-tax profits by about $200 million. Next is HPE. Those shares under pressure ahead of the open after reporting earnings. HPE missed estimates for sales in the most recent quarter after some deals for AI servers were pushed to 2026. CEO Antonio Neri also credited the government shutdown for some of those delays, as well as timing issues with one of its European clients. Sales estimates for the current quarter also came in shy of analysts' expectations. And finally, Victoria's Secret. The retailer reported its highest quarterly sales growth in 4 years, crediting strong performance by its namesake brand, Pink, and beauty offerings. The company also cut back on promotions and raised prices on some items. Victoria's Secret raised its outlook for the full year and says the total impact from tariffs will be slightly lower than originally expected. Well, the bidding war is over. Netflix has won out over competitors Paramount and Comcast to buy the streaming and studio assets of Warner Brothers Discovery. It's a $72 billion cash and stock deal expected to close next year after the previously announced separation of its cable assets. Joining me now, Jason Bazinet, Citi Media and Entertainment Senior Analyst. And I guess the bidding war is over, at least for the streaming and movie studio part of the business. we don't entirely know what's going to happen to the rest. But I mean, this is a surprise, Jason. I know this was not something that was your base case that was going to happen, right?
It was my lowest probability outcome, actually.
Wow.
We only had a 5% likelihood that that this transaction would be consummated.
So how do you think it did then, or why do you think it did? And what about it did you not expect that maybe changed, or maybe Netflix was just thinking in a different strategic way than most people were expecting?
Well, our framework was pretty simple. I mean, we have 3 subscale streaming apps out in the marketplace: Paramount Plus, Max, and Peacock. And we just thought logically that you would see some combination of those 3 to take on Netflix, and described it as a must-have sort of combination if you really want to take on Netflix. We just put very low probability on the industry leader essentially getting bigger. But that's what this transaction says.
Does it make sense to you that Netflix is doing this?
Well, this is sort of the other conundrum. I mean, I think all media companies have always struggled with how to get operating leverage on their content spend. Meaning, how do you spend money in Poland and drive net ads in Poland and have that affect your net ads and engagement in India? It's just very difficult to do. What Netflix has long said is that they're on the hunt for intellectual property, and they're, of course, dabbling in video games. The common substrate that sits underneath those 2 disparate comments is trying to get content that can resonate globally. And that's what I think is what attracts Netflix to Warner Brothers, is they have phenomenal IP in that portfolio. And so that's the real strategic motivation, I think, for the transaction, is getting operating leverage on their content spend.
And Jason, given that, as you put it, you have these other, you have Netflix and everybody else,
right.
Or put another way, you have Netflix and these subscale operators, as you've put it. Does this help Netflix more or hurt the others more?
I don't think in a vacuum it necessarily hurts the others. I think what it does do is it just sort of widens the gulf between the winners and the subscale players. So I don't think they'll get marginally hurt, but it really diminishes their prospects to compete effectively and one day potentially become a Netflix.
Well, and specifically, what does this mean for Paramount Skydance? Because you had previously said that Paramount was the one that needed this deal the most. So how much is it set back, and is it still going to get the other assets from Warner, or the Discovery assets specifically?
Oh, yeah, well, on the latter question, I don't think anyone has real interest in the linear cable nets. What I think Paramount was trying to do is sort of give everything that Warner Brothers wanted, which was, all cash, a simple transaction where we buy all of the assets in one fell swoop. So if this Netflix transaction closes, I don't think Paramount would have any interest in the cable network assets of Warner Brothers.
So what happens to those assets? They just spin off and trade publicly?
Well, yeah, I think that's right. They'll trade publicly. It's there's sort of assets that no one really wants, that really don't have very great prospects. Everyone's just trying to get them off their income statement so it doesn't sully the story. And the question will be for those assets is, do they generate enough cash to pay down the debt to allow some residual of equity value? The street has long thought, and we've thought, that the equity value of Warner Brothers cable net business is in the low single digit level, $1, $2, $3, just because there's so much debt on those assets relative to the EBITDA multiple the street's going to pay for them.
When we're watching Netflix and this Warner Brothers deal, there have been a lot of regulatory questions already, right? You've raised some of them. So what do you think regulators are going to be looking at specifically, and are there any changes that you think they might impose to get this deal through?
I would say this, if you just looked at it through the straight sort of studio lens and you just look at the quantum of dollars that are being spent as a studio, I don't think that this transaction sort of raises any sort of issues. That would be true for any studio combination when we go through the HHI math. I think the potential issue is more on the streaming side, the largest streamer essentially getting bigger. And I think that's one reason why Netflix has said today that they're going to operate those 2 DTC apps sort of separately, that there will be no consolidation, if you will, at that level. And so that So the argument the company is going to make is that there aren't fewer apps that are out there. They will probably bundle to give consumers, a lower price if you buy both HBO Max and Netflix together. That's going to be their argument, and we'll see if it flies with the regulators.
Do you think Paramount is going to try to keep fighting on this?
I mean, there's certainly been items in the press where they referred to a plan B where they might go directly to shareholders to make their case. So that's certainly been reported in the press. It wouldn't surprise me.
And then when this dust kind of settles here, are there other deals to be made elsewhere? What do you think sort of the next phase of consolidation might look like? Or do you think things will be quiet for a while?
Well, one of the reasons that we were recommending Warner Brothers, right, is you had an odd number of those 3 subscale apps. And what it meant is if one of them put themselves up for sale, and you saw a merger among those, let's say of the 3 subscale apps, if 2 of them got together, one was the odd man out. What's sort of interesting now is you have the winner, Netflix, potentially buying one of the subscale apps, and that leaves an even number of subscale apps that are still out there. So the M&A may not be done.
Interesting. Watch this space. We'll be talking again, I'm sure, Jason. Thank you so much. Really appreciate it.
Absolutely. Thank you.
That does it for Morning Brief presented by Robinhood. We got much more ahead on Yahoo Finance. Opening bid is next.